Hey guys, in this video, I want to talk about the dead cat bounce. What is it? What does this mean? How does this impact the market and your trades in particular? So if you're curious to know what is it and how does this impact you, check this video out. Hi everyone, this is Marvin Guillermo, and if you're new to this channel, please subscribe and smash that bell so you get updated every time I come up with new content about investing, about the stock market, about techniques, strategies on how you can trade and win in the markets. And in particular, in this video, we're gonna drill in, dive deeper on what the dead cat bounce is. So what are you waiting for? Subscribe, hit the bell, and stay till the end of the video. Hey guys, so over the past few days, since the market has been dropping, not just in the Philippines, but in other regions around the world, a lot of people have been asking me what a dead cat bounce is, what does it mean, and what's its entire relevance to what's going on today. If this is something that you think is applicable to you, comment, this is for me. Anyways, a dead cat bounce normally happens. Let me give you a setup first. Normally, markets drop. When markets drop, there will be instances where people will think it's already cheap. People will think that there's irrationality in the selling and they start to buy. And if you've been watching the previous videos or you attended the seminars that I've conducted, we always talk about that the market is always driven by supply and demand, meaning more buyers bring the prices up and more sellers bring the prices down. When a stock or an entire market or an index has been sold down, a lot of people will bottom pick. When they bottom pick, that produces a level of buying, and if it produces a level of buying, as you all know, more buyers bring the prices up, so people start to buy. Then you will see a small blimp in the markets or in the stock that you're watching, that it will start to go up. And that's the whole context of what a dead cat bounce really is. So number one, to know first is there should be a large drop before we create a context on what a dead cat bounce is. Then we suddenly see a day or a couple of days where there's a movement up that will cause the stock that you're watching or the markets to go up. Basically, the context of the dead cat bounce is after it moves up, like the term dead cat, you would actually see it start to go down. That the bounce is not something that's real, that the bounce is not something that's sustainable, that the bounce is not something that will actually cause it to start to reverse. I'm gonna show you the charts in a bit, but let me give you the discussion first. So, as you all know, also, when a stock is bearish, when a stock is in a downtrend, when a stock is falling down, they don't go down on a straight line. You don't see stocks that go in long-term downtrends, long-term bearish formations with just one line, boom, sinking down altogether until it drops to a very, very significant point. It doesn't happen that way because of what I talked about. After a large drop, people will think it's cheap and they start to buy. Now, as they start to buy, it goes up, but it will hit a level of resistance. As you all know, when we talk about downtrends normally are created when there's a high that's decreasing and then there's a low that's also decreasing. But for that to happen, there has to be a small type of consolidation that's happening first, or there has to be a point where it tries to hit the resistance reinforces itself, and then it starts to go down. To make this simple, a dead cat bounce basically is a stock that has dropped massively, hits a level of support, is most likely oversold, then it hits a level of resistance, but the resistance is very, very strong, that as it hits the resistance, selling happens and the stock falls down even further, which is a normal characteristic for a stock that's in a downtrend. Another definition I'll give you about the dead cat bounce basically is this: a stock that has been beaten down tries to go up, but because it's still in a downtrend, because it's still bearish, because there's no reversal signals yet that have been evident, that have been shown, the stock continues its fashion and falls down still. So that's what the dead cat bounce is. Now let's look at the charts. Hey guys, so let's try to set a framework here on how could a dead cat bounce actually happen. Please remember, not all downtrends that have a push up become dead cat bounces, because there are some bounces where after it hits a good level of support, it really starts to reverse. But let me just give you some conditions. Number one, you have to see that was in something that was declining, or it was going down, or some people could call it a downtrend. If you try to see this you're seeing now, this particular chart show you that from November up to where it is right now, it's now trying to have highs that are starting to decline, which is depicting what a downtrend really is. And if you look at the moving averages, the 200, 150, and 20, they're all pretty much bearish still. How do we know it's bearish? Because it's below, the stock price is below all of those moving averages, and you also have the RSI telling you that the market is oversold already, meaning if it's oversold, it got sold fast. There's a lot of sellers coming into it. As there's a lot of sellers coming into it, there might be a knee-jerk reaction, but the oversoldness of the market is confirming that it's still also bearish. That being said, short and mid-term indicators are still telling us that it's still bearish. So basically, because it's oversold, because a lot of people sold at a relatively faster level, a dead cat bounce basically could entail that this could start to push up because some people are bottom picking. But here's one thing, you could actually put a short-term resistance here. A dead cat bounce actually means that as it tries to push up, it will eventually start to push down again. Let me try to fix this chart further. As it tries to hit the resistance, it fails to break the resistance, then it tries to push back down, and as it pushes back down, it goes even lower than a reference point. A reference point is this level. If I zoom out, it's actually saying and depicting that, hey, because of its failure there, we could possibly see it go and push down lower, which I mentioned in older videos. There's a specific support level here. So a couple of things also that could depict it. It may also break. Please remember, shorter resistances are weaker than the longer one. So as what I've mentioned also, this is a trend line that's trying to protect the market from going higher. It's preventing the market from going higher as well. So it could possibly break. Let me give you another scenario that it could possibly break this resistance, but as it breaks past this resistance, it still is under the concept that it's still under the downtrend. So if it's still under the downtrend, there's a narrative that it hits this, that as it hits this, it fails to break this downtrend, then it could still slide back down. So that's basically the context of a dead cat bounce. Buying happens at its lowest point, that as it hits its lowest point, it tries to spring back up, but it's not strong enough to break past the resistances that we have pegged. And this is what I want to show you. This is what I want to tell you, that a dead cat bounce is just a label. A dead cat bounce is just what people call a stock that has been sold down, hits a level of support, is oversold, then tries to bounce back up, then it goes down again. But if you notice it, all of it is predicated on support and resistance. All of it, if you know how to read support and resistance, you could forget all of these labels. You could forget all of this name calling, all of what people call dead cat bounce, blue chip stocks, or whatever labels or terms that are there, and you just stick to support and resistance, you'll be okay. So as what I've said at the top of the video, a dead cat bounce basically is a stock that hits a support and bounces, but as it tries to attack the resistance is strong enough that the stock fails to break past it and goes back down again. I hope you guys got a lot from all of this. So please remember, using the ideology of a dead cat bounce is something that you can use not just in today, because please remember, when we study technical analysis, when we study the markets, they always move in cycles. What happened in the past will happen again. What happened before, it's not stopped, because it's people who's investing in the markets. People normally do the same things over and over and over again, and it's always about fear, it's always about greed, it's always about emotion, and those are things that are inherent to men, as they're inherent to people in general. They will just go the same cycle over and over and over and over. So whatever lessons that I'm telling you here, what I'm sharing to you here, it's something that you can use over and over and over. It's not just applicable for today, but should there be a large crash, should there be a large correction, should there be a big drop over the next few weeks or months after this video has been made, you can use this principle still to determine the dead cat bounce. So again, I'll repeat it again. The dead cat bounce basically is a stock that's in a downtrend. It's a stock that's bearish. It's a stock that has been oversold, hit a level of support, but as it hit the level of support, it goes up for a bit, but as it challenges the resistance, the selling is still strong enough to cause the stock to go down further. Now, If you want to know more about this and you think, what Marvin is saying makes sense, but I think I need more information, we have courses, training courses, wherever you are in the world. Our current series now where we do the live training courses will be in Manila this March. It's just a few days from now. Then London this April, May in Singapore and Doha, Qatar, June in Auckland, New Zealand, July in Sydney, Australia. Then this November, we're doing Dubai and Tokyo as well. So all of those things, all of the details on how you can join us are in the description that I've placed here. And you just have to click the link and it will lead you to all of the details that you need to know. Then I'd also like to invite you, for those who want to know more about my online courses. I have an online course, Tagalog Stock Market Basic Course with Chinkitan. It's called Stock Market for Everyone. It's the basics of the stock market in Tagalog version, Tagalog style with Chinkitan. The link is also in the description. Then, for those who want to start their own business, who want to be an entrepreneur, who want to be an investor, particularly in the stock market, we have another online course with Shansi. It's called Make Money, Grow Money. Same thing. Link is in the description. These are for people who don't just want to invest in the stock market, but they also want the rudiments of business and entrepreneurship on how they can make money for them as well. And lastly, all of my books, I talk about the basics of the market, fundamental analysis, technical analysis. All 5 books are available via Shopee. Link in the description below. I hope that it's something that would help you as well, because I believe that some people really like to read still. There's a group of people that like to highlight, like to yung tinutupi yung book as well. So that segment is for you. So I guess that's it. I just want to leave this, I guess, message before we end. No, please remember that markets normally go in cycles, that whenever it goes in a downward direction, especially if it's an index fund. If it's an index fund, you're following the PSEI, you're following the S&P 500, you're following the Dow Jones Industrial Index. It's normal for it to go down, but it always goes back to where it was before. That's something very, very important you need to know. If you're buying a very, very good company, good, growing, large market cap, has a lot of interest when things turn around, also those companies normally go back. So it's always about cycles. It's always about what goes up must go down, and what's down also, especially if the underlying fundamentals are good, the story is good, a lot of institutions will buy into it when things are recovering. Those are the stocks that normally also will go back up again. So that's it. I hope this video is something that encourages you, gives you enough information for you to be able to trade and win the markets with confidence. So that's it for now. This is Marvin Garmo. I hope this video helps you trade well, trade strong, trade smart. See you all again soon, guys, and God bless you all.